Hi, this is Keith, Concierge Tax VIP, and I'm talking to you today about, well, they say it's a great thing, and maybe it is for some of you, but no ta or you get to write off your loan interest on your personal car up to $10,000 a year. So it's limited, but there are a lot of caveats to it. First off, it's only good for tax year 25 through and including tax year 2028. You have a list of limited or of eligible vehicles, and that there's two categories. There's types, and then there are specific requirements to those types. For example, you could buy a car, minivan, SUV, pickup truck, cycle, ATV, and it can even extend to an RV, for example. So, especially if you're a traveling nurse on a W-2, this could be very helpful. One thing that it does not include or help for are people who are purchasing these vehicles for business. So usually you're able to deduct that for business if it is predominantly for business use. The problem here is this would be almost like a double dipping. So the spirit of this legislation or this element of the One Big Beautiful Bill Act is that we wanted to include some benefit for people who are just average wage earners. Okay, which is great. Um, Now, of those vehicles, the final assembly has to occur within the United States, and it so effectively it's excluding foreign-made vehicles or foreign assembled vehicles. So if it was assembled in predominantly in Japan, for example, then it would qualify. However, potentially a vehicle that was partially or fully manufactured, say in the United States and fully assembled in the United States, could benefit from this. Now, as far as your income limits, there's also income limits. So if, well, like traveling nurses, for example, in the previous example, it's not uncommon for a traveling nurse to make well over $100,000 a year. So they may phase out of that. So as you progress past that $100,000 a year benchmark, which not everybody does, most people don't, in fact, then for every $1,000 you go beyond the 100, it reduces that $10,000 limitation by $200. So as an example, if you ended up say, well, easy math. Let's say you made $110,000 or modified adjusted gross income of $110,000. Well, 200 times 10, that's $2,000 off the cap of $10,000. So that means you're only able to write off $8,000 instead of the full 10. Now, moving beyond, just to extrapolate on that, by the time you get to $150,000 as a single individual, in your modified adjusted gross income, then it disappears entirely. So 149,000, for example, you'd be able to get $200. Sorry. Um, Now this is before your itemized deductions or any other exemptions that you might qualify for. So you need to be aware of that. For a married couple, it's the phase outs begin at $200,000. So that disappears again pretty quickly. It disappears entirely at $250,000 in income. In that example, so the tax credit, that's where the tax deduction disappears. So for a household where you've got two working individuals, uh, that is entirely possible. So, but again, it doesn't hurt all of us. And of course, the vehicle must be new. So 25, 26, 27, 28. Um, let's see. Oh, yes. Another limitation. There are certain types of loans that will disqualify the vehicle. So a lease, which is not a loan, but it's financing, is essentially the way it's worded. So leases don't qualify. If you purchase a vehicle that has a salvage title, so it could technically be a new vehicle that was in a flood zone, for example, and then they end up retitling it as salvage. Um, then you couldn't get it even if it was off of a new car lot. If you are purchasing as part of fleet sales, you would not be able to take advantage of this because typically when you're dealing with fleet sales, there's typically a business that you may have that's involved in that process, and so they they decided to exclude that, even if it's ultimately for a personal purchase. You're going to have to go and do it under your own credit and take advantage of it that way. Personal cash loans that are secured by your existing vehicle won't work either. So in other words, you have a vehicle and you go and let's say you own it free and clear, and then you encumber that vehicle with the loan itself so you can get cash to buy the vehicle. Well, that cash would the way you've obtained that financing would not work. It would disqualify your purchase, so you would not be eligible for this. Also, private party loans, say for family members, for example, that would disqualify it as well. So if you got the down payment from mom and dad, then you're out of luck. Um, Deduction will only apply to refinance loans if the original loan qualified. So the original qualification, you have to make some sort of documentation of where the money came from to pay the down and how you acquired the loan and to justify the qualification. That's one of those record keeping requirements over the next few years that you're going to want to have if you are concerned about audit at all, because otherwise you could get this disallowed and then up to $10,000 of income all of a sudden becomes taxable, and then you're in the hole, and then your state, depending on where you live, will follow suit, usually about 6 months, 12 months after that. So you don't want to deal with that. It only applies to loans that are taken out January 1st of 2025 through December 31st of 2028. So we have a limited window for this. Um, the government, under this act, many people like to say the word permanent. Um, in reality, permanent only means that it won't change until Congress changes it, whereas in this particular case, it expires. It's subject to expiration unless Congress at the future date or prior to the future date makes it non-expirable. So so there's no expiration date on it under that circumstance. But currently, December 31st, 2028. This goes away if Congress does not act to extend it. If you'd like to learn more, discuss this, go ahead over to conciergetax.vip, not .com.vip, and book a 15-minute discovery call with me, and we can just chat about it or anything else you may have some questions about that's tax related. I'm not a therapist, so I can't help you with some of those things. Until then, thank you very much. I've enjoyed your time. Thanks for sharing it.